monetary dominance is the combination of the central bank and then the broader banking system, the commercial banks. Their rate of lending or not lending, as well as different things the central bank is doing to try to accelerate the amount of lending that's happening or trying to slow down the rate of lending that's happening. That's all monetary dominance. And then, as you said, basically all the fiscal side, all those different things, that's fiscal dominance. And fiscal, when deficits are lower, when public debts are smaller, monetary dominance tends to be occurring. That basically all those monetary forces are bigger. Whereas when you build up 100% or more debt to GDP, specifically on the sovereign level, and you're running above target deficits that are not really one-time things, they're more structural, that starts to override the power of that whole monetary side, both the central banks and then even the broader banking system.
Data shows the US has been in a monetary dominance phase for 40 years, where monetary policy effectively managed the economy. Lyn Alden explains that we are now shifting to fiscal dominance, where large public debt and deficits drive economic conditions. This change means traditional monetary tools like interest rate adjustments are less effective. The new environment challenges existing market strategies, but offers opportunities for those who adapt.
Market regimes go through these long periods of time where they trade a certain way and there's certain forces that impact them. And so over the past 40 years, the United States and much of the rest of the developed world has been in monetary dominance. And the simple way to put that is that monetary policy is very effective at either kind of reaccelerating or slowing down an economy and impacting inflation. And most of the money creation is coming from bank lending, basically credit creation or credit contraction, which is why those monetary levers are powerful. But in fiscal dominance, that situation becomes reversed, which is that very large debts and fiscal deficits, specifically public debts and then fiscal deficits, those are bigger drivers of inflation or disinflation or rate of nominal economic growth and those sort of things. And the central bank, in this case the Fed in the United States, starts taking a back seat. Their options become constrained by what's going on the fiscal side, because when they raise or lower interest rates, it doesn't impact the fiscal side in the same way that it impacts bank lending, credit creation, that kind of thing. And so, a lot of people, they have these back tests. They have, here's what happened over the past 20, 30, 40 years. For example, that stocks and bonds are often inversely correlated, for example. But going forward, people that were looking at those metrics that were super important during a monetary dominant era are less likely to be, those metrics are less relevant is what that meme means. That basically all these kind of ways of doing things, all these expectations that people developed, they made sense over a period of time. But if it's true that we are entering a different type of market environment, and developed countries have been in this in the past, just not in anyone's current trading lifetime, and emerging markets go through this on a more regular basis, kind of more frequently. But developed countries have not been in this for a long time. And so a lot of people's mental models are kind of tuned around monetary dominance and not around fiscal dominance. So that's what the meme means. And we can unpack what some of that means. Yeah, pretty much. And I guess the one thing I would add is that monetary dominance is the combination of the central bank and then the broader banking system, the commercial banks. Their rate of lending or not lending, as well as different things the central bank is doing to try to accelerate the amount of lending that's happening or trying to slow down the rate of lending that's happening. That's all monetary dominance. And then, as you said, basically all the fiscal side, all those different things, that's fiscal dominance. And fiscal, when deficits are lower, when public debts are smaller, monetary dominance tends to be occurring. That basically all those monetary forces are bigger. Whereas when you build up 100% or more debt to GDP, specifically on the sovereign level, and you're running above target deficits that are not really one-time things, they're more structural, that starts to override the power of that whole monetary side, both the central banks and then even the broader banking system.
Continuing the discussion, Lyn Alden explains that as rates hit zero and begin to rise, debt pressures increase, leading to fiscal dominance. This shift transfers debt from the private to the public sector, causing structural changes not seen since the 1940s. This environment, unfamiliar to many in developed markets, involves higher correlations between stocks and bonds and potential capital controls. Since 2019, the US has been transitioning to fiscal dominance, solidified further since early 2023.
I think the thing I would add is that it's not just debasement per se, because debasement happens under fiscal dominance as well.
Mm,
It's really about that kind of 40 years of declining interest rates, and then the tailwinds that provides to a number of different asset classes. So
mm,
we kind of started from this high point in this current era of very high interest rates, and then you go through 40 years of every time there's a recession, you can cut rates. Generally, inflation is on, even though it's still positive, it's declining from what used to be a high level to eventually by the 2010s, you got to a pretty low level, at least for consumer price inflation. There's obviously different ways to measure inflation, but declining inflation rates, declining interest rates, and basically all that was offset by rising debt to GDP. So, over time, more and more debt piled up on households, more and more debt piled up on the public ledger. And that was offset by the fact that interest rates were declining. And it kind of fed on itself because lower interest rates allow more debt to accumulate. And then higher debt levels tend to slow down economic growth and kind of put pressure on a lot of things, which ends up kind of pushing interest rates down. That's kind of one of those tools that they use to kind of kickstart the next expansion out of a recession. And the problem is when you run into zero, and then you kind of start going sideways to up in terms of interest rates, you no longer have that offset for all those debt levels. And private debt levels peaked around or shortly after the global financial crisis, whereas public debt levels are still going up. And when you look at history of how these kind of really long-term debt cycles play out, so not just the cyclical debt cycles, but these kind of more generational debt cycles when they play out, it does tend to happen in that 1-2 punch where first you kind of hit some private sector maximum, and then you start rotating that onto the public sector. The debt starts getting transferred. So, for example, you bail out the banks, you kind of recapitalize them and push a lot of the debt more on the sovereign level. And then same thing with the response during and after the pandemic and lockdowns. A lot of the more private debt was kind of indirectly transferred to the public level. So you have a little bit of deleveraging on the private side, but that gets pushed up to the public level, and that eventually comes out in currency debasement and fiscal dominance issues. And so basically, I think what the era that's behind us is that ever lower interest rate environment, the structural disinflation from a high level environment, and now we kind of go forward in an environment that really hasn't been seen in the developed world since the 1940s. Japan's been in it kind of first in this cycle among the developed world. You see it occasionally or pretty frequently actually in the emerging world, but it's not something that a lot of developed market participants have a lot of experience with at the in kind of their current careers, because it's all been one trade, which is interest rates keep going down, valuations of both bonds and stocks keep going up, and they tend to be counter-cyclical. They tend to be inversely correlated with each other. But that environment is messier going forward. In more inflationary environments, stocks and bonds tend to be more correlated. And also you start to get, generally during fiscal dominance, you get a rise of capital controls and other issues like that, which can manifest, for example, in this industry, it can manifest in attacks on privacy tools or self-custody or basically the ways to move around capital. So there's overlap there.
mm,
And that's just it's a environment to be aware of. And I would argue that there's not a moment in time per se where you go from monetary dominance to fiscal dominance. Like you're not in 100% of one and 0 in the other. It's this kind of changeover that happens. And I would say there's different ways to analyze it, but I would say at least since 2019, the U.S. has been in fiscal dominance more or less. And
mm.
when it starts to go over, there's like a year or two where you're kind of in fiscal dominance and maybe you're briefly out of it again, then you're back in it until it gets so strong that you're more persistently in it. So ever since early 2023, we've been in it probably more persistently, but kind of this whole COVID era and even just a little bit before it, this was kind of has been a multi-year kind of transition toward fiscal dominance.
Thanks for watching. Here's a quick recap. Today, we explored the shift from monetary dominance, where central bank policies drive the economy, to fiscal dominance, where public debt and fiscal deficits are the key drivers. We discussed how developed countries are entering this new phase, changing the dynamics of inflation, interest rates, and economic growth. This shift impacts traditional investment models and introduces new challenges like rising capital controls. If you found this video insightful, please like, subscribe, and hit the notification bell. Share your thoughts in the comments below.